You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again. Time to roll out the red carpet for a little bit of fun on the Advisor's Option, the program for you, the busy financial advisor or asset manager. We get it. You're busy out there dealing with your clients. At least you should be. These markets are crazy. Have you seen what's been going on out there? Whipsawing plus 1% down, 1+% intraday, moves all over the place. A little bit of vol sneaking back into the equation as well. So a lot to unpack here on the show. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which all of you folks are binging these days. Hope you're having a good start to your trading week. It's going to be a good one. If you're hanging out in the live, stay tuned. We'll be back in a little bit after this show with our good buddy, Mr. Dr. Vix. He's talking some of his latest research and tackling a whole bunch of your questions on the Pro Q&A session. That'll be coming up in a little bit. You don't want to miss that. His sessions are always popular. Where do you go to get those? theoptionsinsider.com/pro is the place to go to get access to that and 300 plus other episodes that are waiting for you there. The second you hit that button. All right, and let's see who's joining us on the old program today. I am pleased to be joined once again by my compatriot, my partner in all things Advisor's Options crime. He is the founder over there at ORATS, also known in the local New Hampshire area as the father of the rogue AI known as Otto that is terrorizing the countryside. He is Mr. Matt Amberson from ORATS. Mr. Matt, welcome back to the show, sir.
Yeah, I just got word from my technical staff that a crazy question was asked of Otto on orats.com, Mark.
Who would do such a thing? I am having fun. I must say I'm having fun playing with Otto here. I might be distracted during the show, so Matt, if I don't respond to your questions right away, it's because I'm having fun with Otto. Talking to him about Matt and about UVIX and all sorts of fun. Really quickly at the top of the show, Matt, if folks want to check out Otto for themselves, where should they go? What should they do?
Yeah, so Otto is our AI, and we've trained him pretty well. Asked him many questions. So if you have any questions about ORATs, I actually asked him a question today about contango. I couldn't remember if contango uses X earnings volatility, so I asked, just type in there contango X earnings, and Otto answered it for me. Yes, and indeed, contango uses X earnings volatility, so it takes the earnings effect out, so you could see which stocks are trading how much above. If you want to buy a time spread, you want to look for stocks with negative contango or backwardation because you're selling the front month, buying the back. So I have the scan that looks for cheap calendars, and so I use contango to find the stocks, and then the stock scanner automatically connects to the option scanner, and we could find these cheap calendars, and Otto led me in the right direction, Mark. So orats.com.
There you go. Check it out, listeners, as we check out a little bit of the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, listeners, it's been nigh on a month since we fired up the old advisor's option. An eternity in these markets where so many people are living minute to minute using the 0-day options these days. So going back a whole month, it has been a crazy, tumultuous month out there, listeners. We've seen a little bit more of a color recently that we haven't seen in quite some time. Yes, I'm talking about red on the major index front as we rallied north of 5,500 in the S&P 55 half. Then we started to see some weakness. Of course, we started to see the markets get a little bit choppy, a little bit topsy-turvy, and started to see some aggressive sell-offs, also some equally aggressive rotation out of some of the mega caps in the S&P and the NASDAQ and into the Dow, and indeed even more aggressively into the Russell 2000. Russell 2000 did a year's worth of living in about 10 days over the course of the past month, just rampaging to the north and then coming back down. We saw signs of very aggressive action out there to the tune of the call wing and the skew actually getting bid for a while, which you very rarely to ever see in a major equity index. So a lot of fascinating things afoot. We also saw VIX very recently getting spiked up to nearly 20, about 1930, I think is about the apex for the VIX cash before coming back down. We are rallying again today in the vol space, and of course, the market's selling off. As we're recording this right now, late July, listeners, NASDAQ's off about 1.25%, the SP off about 0.5%. Dow managing to turn green, up about 0.4%. And our old pal VIX Cash, after spending the better part of the last month and change down around the 12 to 13 handle, and then roaring back to life up to about a 19 and the third, now hanging out as we're kicking off the show at about a 17.5. So, Matt, it's been a wild month out there in the market, sir. What has caught your eye?
Yeah, I was just looking at that IWM. ORATS uses the term slope. So, and we call it a positive slope, even though it's probably better to look at it as negative, but we call it positive slope. So generally markets, market-wide are 4% to 8%. I was just quoted in risk.net magazine, not just quoted, they put my entire zero DTE argument in there, Mark. You should check it out sometime. But one of the things that we were talking about was the slope and how it's really kind of flattened out since zero DTEs have been introduced, and we've seen that. I mean, almost to the day, May in the year 2022 is when basically the support for slope became the resistance. So it's in a different paradigm. And yes, like you said, IWM, I mean, right before it just took off, people had to know because you could just see the slope falling and the stock taking off. That was one of the bigger dislocations I've ever seen trading, Mark. So that's definitely catching my eye. And then the overall slope that we would look for in the IWM on the other when the meme stocks were going off. That's calmed down a bit, so the meme stocks aren't quite there. So it's just basically the rise in volatility. However, we still have these trend lines that we automatically draw in our trade builder, and we're still in the uptrend in SPY. So we're right against it, but I think that's kind of supporting the market, and it's a battle between the bulls and the bears right now. If it breaks that trend line, Mark, I think it's going to be down a bit, but I think they're fighting it right now. So I think we could see some positive moves if it doesn't get underneath this line. This is a big battle right now, Mark.
I'm sorry, I was distracted. I was chatting with Otto. Let me get my attention back to the show here, proper listeners. Yes, but a lot going on out there, listeners, and a lot continuing to unfold as we speak because we are right in the teeth of earnings season, listeners. So let's get to it. A little bit of the old earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report, the portion of the show where we do just that. We break down how earnings vol is shaping up, what's going on out there, and how it's driving and impacting the markets we all trade in day to day. And if you are ignoring earnings volatility, listeners, right now, then you are doing so at your peril. You could argue that earnings vol has maybe, at least in recent memory, never been so pivotal to what's been going on out there in the markets. Of course, this market has been carried on the backs of really two things: the prospect of impending rate cuts. We all know what happened there. And then, of course, the looming specter of the impact of AI and how that's going to reshape everything, quote unquote, out there. We've yet to see one deliver, and the question now is, can the AI start to deliver at least on a meaningful level on the bottom line? We saw from Google the answer maybe not that kind of spooking some people recently, so a lot of focus on big cap and tech earnings coming up this week. We got some even coming out after the bell today. One of the vanguards of the AI movement, of course, Microsoft and their relationship with OpenAI, they'll be popping off after the bell today, so that'll give us some insight. I have a feeling if they spook some people, that could send the market into a bit of a tizzy out there. Meta, another big one tomorrow after the bell. So we are right in it. Thursday, we have Amazon and Apple. So listeners, we are hot and heavy in earnings season. Also looking at the data, which Matt and his team crunches over there for our earnings move results, earnings season, and earnings trade reports, which you can find over there, theoptionsinsider.com. Click on the Options News and Articles tab to begin your journey to the dark side of earnings vol, listeners. I'm looking at these numbers, and I'm hard-pressed to think of another time, Matt, when we had such robust numbers coming out on the earnings vol front. We've been crunching these numbers for a long time, certainly since before the onset of the pandemic. We all know what happened during the pandemic. Earnings volatility got crushed, and no one really cared what any firm said. It didn't matter anymore. We are definitely in a very different environment right now. Last season came in, listeners, at an average of 113%. Of course, 100% is effectively as if every name moved exactly as much as they were pricing into their straddles going into their announcements. So 113%, a very explosive cycle. In fact, that is the highest we've seen our average, I think, since we've been crunching those numbers. And not to be outdone, this cycle is already kicking things off with a bang, listeners. Week 1 was 116%. Week 2, and again, Matt, I'll need to crunch the data to make sure, but I do believe week 2 at 155% may be the most outperformance we've ever seen in a week for earnings. So we're tilting with some very rarefied air here, Mr. Matt. What are your thoughts on how last season finished up and how this season is shaping up, sir, on a historic level?
Yeah, so unfortunately, I think that the huge number is just because a couple of them just move so much, but still, I mean, there are the 25th of July last week saw about 20 stocks move over 100% over what their expected earn rate move was. So I don't know, Ford moved a lot. What other? Lazy Boy, Pool. It was a pretty crazy week last week. I haven't seen a big week like that. I thought there was something wrong with the numbers. Then I went and looked at all the results, and yeah, it looks correct. And even this, only a couple have reported so far this week that it made the report. But we're up again. So we called it, Mark. We called it that it was going to be another good earnings reporting season for option holders, and it has been that. So pretty crazy out there, Mark.
So yeah, we're shaping up for another banger season out here so far, Mr. Matt. Anything really standing out to you in terms of, you mentioned Ford last week, certainly a bitter disappointment for anyone who was excited to see the stock back up at a 14 handle and now back at a 10 handle. So you're right. Outperformance there, perhaps not the way people wanted, at least the holders. But anything else on your radar right now in terms of names you're looking at, or maybe overall trends for the season and what you're anticipating, sir?
Yeah, I mean, like UPS was down 13%. The expected was 5%. And it's just been that kind of a season. And even today, like you mentioned, Microsoft is coming out with their earnings, and the implied earnings, they're starting to push it up. So now I think people are starting to get what's going on out there, and they're starting to push up what's the implied moves by, just buy. It just seems like there are more buyers. Maybe there used to be more sellers before, but if this continues, it will be our biggest earnings season since we've started taking these. Since you pushed me to make this report, Mark, I don't even know how many years ago it was, but yeah, it's a big one.
Speaking of big ones, one name leapt out to me. I just mentioned Meta is coming up. And again, you listeners, you can check out all these tickers for yourselves over there at theoptionsider.com. We could spend the entire show breaking down the dozens upon dozens of tickers we have available for you. But one leapt off the page to me, Matt. Maybe it leapt off to you as well. I'm looking at Meta. They're popping off the 31st. So tomorrow, as we're recording this, listeners, probably in the past as you're listening to this down the road. The stock at the time we ran this report, $465.70. They were pricing in $38.53. In the past, they've moved 61 and a quarter. This cycle, we're not seeing a lot of earnings vol discounts, Matt, but it seems like it's almost a fire sale on earnings vol in Meta right now. Mr. Matt, what are your thoughts?
Let me get that, Mark.
It's right there on the page for you.
Oh, yeah, there it is. So, yeah, I mean, that is, you're right. It's 4.5% under the past earnings moves. I might have to go to the old ORAT's dashboard, type in Meta. So on the dashboard, what we have are the last 12 earnings moves, and you could see how many times Meta has been outside of their implied range. And there have been some big moves, unbelievable moves in Meta. And so, so what you're looking at, is the valuation based on, what are the past earnings moves, and it's so much underneath that. So why is that? And I think it's because in the measurement of the earnings moves that fall underneath that kind of 12 quarter, the rolling past 12 quarters, we've had a 26.4% down move. We've had a 17% up move. We'd have it at 24% down move, 23% up move, 13% up, 20% down. The last one was 10% down. So now with Meta at 8% implied, which is pretty high for, most stocks. You're not going to see 8%. And we think it's a fire sale because what we do is we compare the implied earnings move to actual moves. And, it looks like it's on sale. But if Meta does another one of its 20 handle moves, it's gonna double it again. So yeah, that's a good catch, Mark.
Yeah, that one left off the page to me yesterday as we were doing the option block, and I wanted to make sure we had a chance to discuss it here because we don't see that too often. Obviously, these things can be impacted by a few outlier moves, but as you pointed out, there's been almost nothing but outlier moves for Meta since we've been crunching the numbers out there. So by way of comparison, Meta might be looking like a screaming deal out there. I suppose we will find out the truth tomorrow, listeners, as we keep on rolling into a little bit of Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everyone, welcome to Options 101, the portion of the show where we break down a basic options concept or technique or strategy and explain how you can utilize it in your clients' portfolios. Today, we're going to get maybe a little bit more advanced. This might be more reasonably described as a bit of an Options 201 because we're moving beyond some of the traditional realm we normally talk about, getting into something very specific known as weekend risk. The name pretty much says it all. This is the risk we encounter over the weekend in your clients' portfolios when most of the products they trade are closed. So obviously, we've seen literal examples of this just in the last couple of weeks. A few weeks ago, we had a very near miss assassination attempt on a former president and current presidential candidate. Literally the weekend after that, we had the sitting president step down from his party's nomination, no longer vying for the presidential seat there. So two back-to-back pivotal, nigh on unprecedented events playing out over the weekend, listeners, when everything is closed for the most part. I mean, if your clients are slinging some crypto or some futures, then they have a little bit more access to those products. But for the lion's share of your long equity clients who are hanging out in the S&P or in your Apples, Metas, and your Amazons, and all that fun, those are closed. So that brings up the conversation of how do you hedge this? Matt, let's start there before we get into some examples. When I say to you the term weekend risk, let's play a little word association. What leaps to mind, sir?
Yeah, I mean, first of all, it's a headache for us to value Monday's implied volatility versus Friday's implied volatility. So because we always use calendar days. And the reason is because we're out there to the public, and most people understand calendar days, not necessarily business days as much. So, so how much weight do you give to the weekend is always a big question. Is it just one day, like a normal day? Is it 2 days? It's a very difficult question, and because as you have pointed out in your examples, you have a lot more time for a lot more kind of big macro things to happen. Whereas the business press is pretty quiet, and what happens with company announcements are quiet over the weekend. Obviously, there's a lot of global economic and just geopolitical stuff that happens on the weekend. So how do you value it has always been a tough thing for option traders. So, what we've done is we've said, okay, well, we're just going to do it at the calendars, and then people can, understand just from the relationships that we're doing it that way. And because right now, normally it looks like a lower vol, and then when it comes to Monday, the vol kind of goes up. So, when I think about the weekends, Mark, I think about the difficulty in pricing and communicating implied volatility, just on a normal inputs to the Black-Scholes formula is, percent of the year. Do you use a percent of the year that has to do with that has weekends in or that doesn't? So that's what I think about, Mark.
Yeah, there's obviously a lot of different ways you could tackle this risk, listeners. The first one you might have to ask yourself is if your clients are starting to ask you about this, or if you're starting to really sweat the weekends, then maybe it could be a time to potentially close out or scale back some of those positions. That is certainly a viable way to deal with this. I know it's kind of on the nose and there's tax implications to that, so not everyone wants to think about those options, but they are certainly viable ways to deal with some of this risk. If you're feeling a little overvalued, a little heavy, maybe your clients are feeling a little bit anxious right now, it can never hurt to maybe scale back some of that or close it out entirely, again, as long as you're okay with the tax hit that could come along with that. Another thing that has really gained a lot of steam lately, and a lot of it, I think the unheralded aspect of zero DTE is what we're talking about right now. I've talked to a lot of very experienced derivatives traders who are knee-deep into the world of zero DTE. They're all in. They've been sucked in. And whenever I talk to those folks and say, okay, well, what is it? What has lured you to the dark side of DTE? Zero DTE. They almost invariably say to me, it's that. It's the fact that they go away in one day, so they, by definition, have to go home flat. There's no overnight risk. There's no weekend risk. It's just a much easier prospect for them, I think, mentally and position-wise to have to deal with out there. You know, the goal when we were all market makers was to go home flat every day. You never really got there. You always had some residual Vega or Theta floating around in your portfolio. But with zero DTE, it all goes away at the closing bell. And I think for a lot of people, certainly post-pandemic, that's a huge plus. They don't like having that overnight risk. They don't like being exposed to, if an errant assassin's bullet moves a half an inch to the right, your portfolio is selling off, limit down the next open. You know, they don't want that in their lives. And so the zero DTE might be a perfect solution for a lot of you out there. Matt, what are your thoughts on folks embracing zero DTE specifically for this reason? There really is no overnight or weekend risk, sir.
Yeah, I mean, zero DTEs, people have made a business out of, and it's because you can trade it every day and come in and be consistent with your trading. And you're right, you don't need to have that risk that is outside the business day. And so people, traders, they want to get rid of as many unknowns as possible. There's already enough in the market during the market day, like what happened today during the trading day. The market just like plopped down to 1% or over 1%. So there's enough that goes on intraday, and so I think that's one of the benefits and one of the reasons that zero DTE is so popular, that you don't have to hold things overnight. I remember back when I was trading, people in the big indexes wanted to be flat their positions overnight. And I'm like, how is that possible? I was in these small names, and we would be married to our position for a year or more. So we had to just carry, in order to get the profit from the trades, we had to carry it for a long time. So yeah, it is awful nice. And it's a luxury to hold it, to not to have positions. But again, people are paid to take risks out there, and often the weekend decays quite a bit. When you come in Monday, the things I actually put a note in before I even know we were going to be talking about this a few weeks ago. We do these estimates of where we think the VXX will be in terms of VIX, and the VXX always seems to go down more than it should over the weekend. And I always wondered why that was, but so that I go, don't be long the VXX over the weekend. So that's a note I sent to myself. So, you have to be careful over that time frame, Mark. There's a lot that could happen, and it's a strange deal out there.
Well, you mentioned VXX. That's obviously in the vol space. I have some thoughts about that as well, but let's get to some of the more obvious, I think, candidates people will have. So if they don't want to scale back or close out their positions, or they don't want to move their clients into zero DTE, which I get it, for a lot of financial advisors, zero DTE is just untenable. It's just too much day-to-day management for them to really handle and also deal with their clients. So there are some other approaches, and we'll go through some of the obvious ones, and I'll get your thoughts on them as well, Matt. The obvious one people approach us with all the time is the notion you're heading into a weekend, you have a long, let's say broad S&P portfolio for your clients you want to hedge. The obvious question then becomes, what if I just buy a weekly SPY put to hedge it? You know, you're going to the close on Friday, right towards the close, you buy that SPY put. Luckily, SPY now gives you the range of expiration. So again, you don't need to trade 0 day to take advantage of the expirations that they offer. You don't need to go out and buy an option, I should say, expiring on Friday to hedge your clients' portfolios anymore. You can go out on a Friday evening and buy the Monday expiration in SPY or SPX or whatever you're trading. So that gives you a little bit more targeted perspective. Now, you know, the downside of that is going to be pretty obvious no matter how tight you keep it, 1%, 2%, 5%, 10%, whatever you go out of the money. Obviously, in order to get this done towards the close on Friday and then get rid of it immediately on the open on Monday, there's going to be some obvious slippage in that. So you have to be comfortable with most, if not all, of whatever you pay for these out-of-the-money puts going into the weekend, all that money going the way of the dodo, or at least a large chunk of that. And again, that's not exactly palatable to a lot of clients and a lot of advisors out there. So that's kind of a scenario that I would really only use in, you know, some of these situations like we saw just a few weeks ago where there was an expectation heading into the weekend that Biden might indeed step down. So there was a bit of a known unknown lurking out there. In those scenarios, it might behoove you to have something in your back pocket for a rainy day. It turned out not to work out this time. The markets rallied on the open, Vol got killed. But in those unknown scenarios, sometimes it can behoove you. So Matt, what are your thoughts on that approach? Your clients are starting to get spooked. Maybe you as the advisor are getting a little bit spooked. So you decide to start putting some, let's say, Monday expiration S&P puts in your back pocket for a rainy day, sir.
Yeah, so I don't know if this is going to sound odd or not, Mark, but if I had to protect a downside, I would not like to own short-dated anything over the weekend. I think over the long run, you're going to find that actually is a bigger loser than owning regular a time frame. So what I would do is I do that out of the money put calendar, and that will, again, as the stock goes down towards your long, you will. I mean, that's exactly what you want it to do, and you can make it so you're actually getting theta. So that's you have to be careful that it doesn't go past your strike, because then your protection's not there. But that is the strategy that I would be interested in, and that's something that I do to protect, because again, I'm trading that short VXX, and I'm long put calendars kind of all the time. So that's how I would tend to work it, Mark, because I think other than that, it's just going to be way too expensive.
Yeah, it's challenging to do that. You're right. In most scenarios, it's going to be a huge drag on your position, but maybe for those one-off scenarios where you're especially concerned, it is an option out there, pun intended, and it will be lower cost than it used to be where you had to buy the monthlies or even the weeklies. Now you can really just go till that Monday morning on your hedge. So something to bear in mind. If there are those handful of weekends where you really just are having a hard time sleeping, then maybe that could be just a little bit of a panacea for the soul for those dark nights. All right, let's keep rolling. Let's go the other way. Matt, you've talked a lot on the network of late about your new favorite trade outside of the put calendars in SPY, which is, of course, the garbage, the out-of-the-money call in VIX. We talked about it a lot. Go back into the archives if you want to hear more about that. Other people have asked us in the past, Matt, what about hedging my weekend risk using VIX? Now, there's a couple of differences to keep in mind here with VIX. First off, you don't have the wide array of expirations in VIX options that you do in the S&P. S&P pops off every day. VIX pops off on Wednesdays. So that's your first difference. If you're on Friday, you want to buy some sort of hedge that goes through the weekend, you're going to have to go till at least Wednesday. So bear that in mind. It's not quite the one-to-one hedge that the S&P gives you out there in terms of time frame. That said, the nice thing about that is that, if you buy the Wednesday option, you come in on Monday, you're still going to have a little bit of value left in that you could hopefully get something for, as opposed to the Monday option in the S&P that it's not going to be worth much once Monday starts trading out there. So something to bear in mind. It's not quite as tight. And then also the argument we've had many times on this network in the past, whether VIX itself is actually a hedge. I think we both argued on this show that VIX is not a hedge. The only real contractually guaranteed inverse correlation at the end of the day is an S&P or some sort of put option. So a VIX call, a lot of things go into that calculation that could gum up the works. We've also seen a lot of very short-lived pops in VIX recently. Just look back over the last 6 months or a year. You could see just a litany of wreckage from VIX popping intraday, only lasting for a few hours and coming off aggressively. So the other side of this is if you do have these in your back pocket, you're going to have to monetize them fairly aggressively in order to make them work. But Matt, what are your thoughts on this approach instead? Going out, let's say on a Friday, you're buying the VIX option, let's say 10% out of the money call in VIX, expiring the following Wednesday, and then trying to close that on a Monday. What are your thoughts on that, sir?
So I like the VIX better than VXX or any of the other ones. And of course, as you know, I like the garbage VIX calls. And so that's what I would tend to think about is, and I wouldn't, I understand what you're saying. So you do, maybe that Wednesday buy some, and the garbage on Wednesday has garbage in the longer term. So meaning it isn't that far out of the money, the crazy far out of the money that I usually would trade. So that's the type of thing that I might think about. It's very inexpensive options that protect against just a major debacle is something to think about, Mark.
Yeah, and in fact, you're going to shell out more for it because it goes to Wednesday, but also you're going to keep more of that residual value at the end of the day. So you're right. It does maybe a little bit more palatable for people out there who are worried about just throwing all of their money away to the theta monster over the weekend. All right, you mentioned VXX a bunch. Let's get to some of the more esoteric ways people have approached hedging their weekend risk. One of them is with our good buddy, Mr. Dr. Vix, coming up in a little bit on the Pro Q&A. He's the one who first whispered this in my ear, Mr. Matt. And he was saying he's been back testing this for a little while, and he hit upon this strategy for hedging weekend risk. And again, listeners, this is, again, a little bit more advanced, 201, maybe even a 301. So if you're not familiar with all these products or concepts, that's fine. Go into our archives, check out some of the educational material. Go check out the show Volatility Views, where we discuss this strategy in more detail. Maybe it'll make a little bit more sense for you there. But listeners, there is a levered volatility ETF out there known as UVIX. It is 2x VIX. So it gives you exactly what the name implies, which is wherever VIX is going, UVIX is getting there to double the speed. So for if VIX is too boring for you, UVIX is out there. Now, the downside of all these products that attempt to replicate some sort of VIX futures position, or in the case of UVIX, doing it on a levered basis, is that they suffered from very aggressive roll yield, negative roll yield. So all things being equal, if UVIX underlying, let's say, is trading $10, if you can't buy and hold this thing because it is going to lose value over time. The amount of value destruction in these products is stunning to watch. Go look at a long-term chart of any of them. VXX, not even levered, just one-to-one, or UVIX or UVXY, all these products that attempt to do this. Long-term, they lose a tremendous amount of value. So these are not buy and hold products. But we're not talking about buying and holding for a very long time. We're talking about buying UVIX, the underlying, not the options. That's a key point. And again, until Russell started whispering this in my ear, I don't think I've ever owned UVIX underlying in my life, except for maybe the handful of times where I had a put assigned to me. And I immediately got out of it because holding UVIX underlying is like having liquid napalm that just burns through your fingers. It erodes so quickly. So you don't want to own UVIX for long. But in this case, it's a buy right around the Friday close. Russell actually surprised me. He said he's been back testing it a little bit by doing it a couple of hours before the close, not quite on the closing bell. So that gives you a little bit more exposure to the last minute fluctuations of UVIX. It's up to you whether you like that or not. I'm not a fan of that. And then dumping it immediately on the open. And around his back test, he found that it worked about 50% of the time. and then it lost money, 40 odd % of the time. And so he found it to be a lower cost, and the times you made money made up for the loser. So he found it to be a very premium, profit neutral way to try to hedge yourself against something crazy happening. I have a literal example of it, though, not exactly maybe playing out the way you could think. Of course, a few weeks ago, I mentioned the known unknown that was the potential for Biden to step down. So Dr. Vix was on our VolView show that week. It was myself, a good buddy, Mr. Andrew Giovinazzi, and myself. And we all talked ourselves into trying this trade for ourselves. We thought if ever there was a weekend to perhaps have a little bit of UVIX in your back pocket to protect against a known unknown, or an unknown unknown for that matter, this is the weekend. So we all went in and bought it. Russell ended up buying it, I believe, earlier in the day for around 618. I bought it right towards the close for 612. The Rock Lobster, that shady bastard that he is, got it for 610 somehow. So he scummed me by a couple of cents. He was messaging me over the weekend when the news happened that Biden was dropping out. That was on a Saturday. He thought, here we go. And so I said, well, we'll wait to see how the S&P futures open on Sunday to see if this is working out or not. And sure enough, we had the futures opening higher, and they opened higher on that Monday, and vol got annihilated that Monday. So I ended up bailing on my UVIX on the opening print for around 585. So not a huge hit, but again, by no means a winner, even on a weekend where you would be forgiven for expecting vol to have a little bit of juice. And Matt, the one thing I was kind of leaning on with this strategy is something we've noticed a lot in the past, which is, the weekend effect of volatility. And ever since weekly options really became popular, we noticed people aggressively selling them into the weekend and perhaps overselling them. So what you traditionally have with VIX cash is a little bit of a pop on the open on Monday as they're quote unquote getting the weekend back. So I thought at the end of the day, that would be my saving grace. If all else failed, the little bit of that weekend effect would kick in and I would at least be able to scratch this thing. Turns out that was not the case. I tracked it. If you did it again this past weekend, same deal. You could have bought UVIX again for right around the same price, about 612 up to 620. And on the open, you would have dumped it for around $6. So again, another loser back to back, which is kind of interesting. Mr. Matt, what is your thought on this particular approach of buying UVIX right around the close and then getting rid of it right on the open on Monday, sir?
Yeah, I mean, you see the graph of UVIX, and it looks like all those other ones that just decayed as 0 from 1,000. So, I trust Russell. I mean, obviously he's knows a lot, but and maybe he's tested this out. But it just looks like that's something that you could just do, and I just see that being an expensive way to, there's a lot of decay there over the weekend, double long VIX futures ETF. So, I don't know. I'd have to test it, but it sounds interesting, but I'd have to test that one myself, Mark.
And you noticed something about VXX as well, something similar, maybe a bit of a reversed weekend effect? Tell our listeners about that.
Yeah, I mean, so what we would do on the weekends, it was look at the relationships between VIX and, and try to predict where we thought VXX would be. And VIX is often up and VXX is often down. So it's not even, going in the right direction. So I'd much rather be long VIX and short VXX or short UVIX than long than long VXX or long UVIX.
We actually went longer on that than I thought, but it's a fascinating topic. As you can see, listeners, a lot of different ways to approach it. Matt, you like that kind of, I think it's a 1 week put calendar. Is that what you're doing out there in SPY? Any other things you want to leave folks with and takeaways regarding weekend risks?
Yeah, I mean, this isn't going to help people hedging, but I would do something long VIX and short call spread in VXX, or short deltas in VXX, long deltas in longer deltas in VIX is something that I think about, Mark.
There you go, listeners. So I'm curious for you, is this a subject that's come up with your clients? Is this an issue you've had to tackle or confront, this notion of a quite literal weekend risk? We're all grappling it with it, listeners, and there are many ways to skin and carve up that onion. So I'm curious, what are your thoughts on this, listeners? Have you tried any of these? Maybe there's a different way you like to approach weekend risk. Again, it's all subjective out there at the end of the day. We want to hear from you. Speaking of hearing from you, It is time for a little bit of the old office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, listeners, we are overdue for our mid-year question palooza. Of course, we went a little long on that weekend risk and that, but it's a fascinating topic out there. So don't worry, we will tackle more of your questions on a future episode of the Advisor's Option. Oh, speaking of VXX, really quickly, Matt, this is right up your alley. You were just talking about VXX. Our question of the week right now for our audience, Matt, is VXX just had another reverse split. At the time we posted this on Monday, it was trading around $46. I think it's higher now, $47, $48. It's a 4-to-1 reverse split. Again, these products erode in value continuously, listeners, so they have to reverse split continuously in order to maintain some sort of viable trading range. Does this reverse split make you more interested in trading VXX? We gave our audience 4 choices. Yes, the erosion trade for the win. No, you don't trade vol or VXX. No, you prefer other products, so you like something else in the vol space rather than VXX. Or you never stop trading it. Mr. Matt, what are your thoughts on your beloved VXX and, of course, the reverse split? And then more importantly, what do you think our audience is voting for?
Well, I think when you reverse split it, there are more strikes that are meaningful, and you could do the trades that you want to do. So I would say, yeah, it's a lot more meaningful. And yeah, like I said, the VXX trade that I do is the weekend trade. Get short on Friday, buy it Monday. So those are my thoughts on VXX. And if you and just look at a graph before you trade it. I don't trade. I like to trade a lot of these. I think I mentioned it a few times that some of my clients are just so into these ETNs and that they know every little thing in the prospectus, and it's tough to. And there are things that can help you if you're really going to trade these. You really need to know the product, and I don't think I have an edge there, so I don't tend to trade it that much more. So I'm me, I'm shorting. I never am short units. So
that surprised me.
I'm selling a call spread or buying a put spread, depending on the deep in the money put spread, just depending on the pricing there.
Well, our audience is certainly more intrigued. 53.8% saying they like this, more erosion for the win. 23.1% say you don't trade VXX. I get it. 15.4% say you never stop trading it. Even if it was down around $10, you still loved it. And only 7.7, I thought this would be higher, say you prefer other vol products out there. Let's jump to some other listener questions on the time we have remaining. Listeners, let's go out to this question. This question from, it's a whole mess of letters. LEAFC, maybe he's a CFP. So let's go Elia F, who is a CFP maybe, or it's just a mess of letters. Either way, the Elia FC CFP says, I've heard both of you mention that protection is, quote, cheap right now, or at least low cost in SPY and other leading indexes. How do you determine that? What level is considered cheap? Thank you very much for producing this program. Well, yes, LEAF CFP, we have said that. That was the case until some of these shocks we started seeing in the markets a few weeks ago. So let's crunch the numbers now. Matt, your boy Otto is always crunching the skew numbers out there in SPY. Elia wants to know, how do you determine when a skew is cheap? What level is considered cheap, and how do you crunch that number, sir?
Yeah, so I think these people make names that you can't pronounce, Mark. I think that's
that's the whole point. Yes,
I think that's what they're trying to do. So, when we say that protection is cheap, we're saying the put protection is cheap. It's a shorthand for that. And the way that I look at that is through our slope figure, or that's as a slope figure. And you could look at a slope percentile for a month or for a year, or just the the number that it's trading, or look at the graph. But you have it, and I would say it's relatively cheap, meaning it's relative compared to the calls. So, if I were buying puts right now, volatility is pretty high. I'd sure like to be short something against it, which is difficult to do. That's why I do the put calendars, because you're longer term put calendars, you could do that and just be careful you're not doing it in too much size, because when the vol comes down, it's going to come down in everything, and it comes down in long terms as well. And there's a lot more vega in the long term. So I would say that the skew is relatively cheap right now. But as far as overall cheapness, the vols come up. So vol goes up, protection goes up when the house is on fire, and it might not be on fire right now, but there's some smokes that you could smell. Mark.
Yeah, it definitely was inexpensive, I would say, a few weeks ago. It's still, compared to historical, as Matt said, not ridiculous, but a little bit juicier now for obvious reasons. We've seen a little bit more tumult in the markets, more sell-offs, and vol has ticked up. So that makes a certain amount of sense. Since we're talking about protection, let's get this one in here from a much easier to pronounce Michael. Michael says, "So glad I discovered this program. It is truly unique and informative." Well, thank you very much, Michael. He says, "Your program has mentioned collars in the past. I understand their utility and how they work in indices, but can they also be applied to other asset classes for clients, particularly fixed income and the precious metals, including gold and silver?" I think collars work extremely well in the metals. Metals are almost designed for collars. Listen to our TWIFO show, listeners. In the collar, ideally, you'd like a scenario where the call wing is bid from a vol perspective and the put wing is offered from a skew perspective. And you see that routinely in the metals. So what that means is you could buy the underlying, sell a fairly out-of-the-money call, and buy a really tight put to protect it, and do that for a credit or do that for a fairly nominal outlay, and give yourself a decent amount of room to run to the upside and still protect it very tightly. So metals, I think, are almost uniquely designed for collars. We see this in the ags every now and then too. And again, check out our This Week in Futures option show if this intrigues you, listeners. We talk about the skew there a lot. In fact, you can see those in our This Week in Futures options reports. They crunch them for all of the assets that trade at CME. So that's the metals, that's the ags, that's equities, that's whatever floats your boat. FX out there. And ags are the other product class and complex that I would say more regularly exhibits this type of commodity skew, is effectively what they call it, where, the upside calls are bid and the puts are offered. Again, that's attractive. Soybeans will do this every now and then. Corn. Whenever a ag product has an aggressive pop to the upside, that's when you'll see a lot of these types of skew situations set up, which makes them very attractive for collars. In a regular index like the S&P, like we were just talking about, where the puts are traditionally bid from a vol perspective and the calls are traditionally offered, it's not a great setup for a collar. You're paying for that collar usually, depending on how you set it up. So yeah, it is interesting. If you want more data, obviously the skew we have in our TWIFO reports is a great starting point. It'll show you how the skew is lining up. Also, I mentioned on the show in the past, I should probably just put a link to it in the show notes. It's an older study now, but it was done by our friends over there at the Options Clearing Corp. And it tackled this exact question. It took a variety of different collar setups and applied them. It starts in the Qs, and then they go from the Qs into a variety of other assets, including gold, including ags, and a bunch of other things out there. And they determine the efficacy of collar strategies across a wide array of assets. So exactly what you're asking for, Michael. I know the original study was called Collaring the QQQ, so I would search for that. You could probably find it on the OCC or OIC websites as well. And then there will be addendums to it that add other asset classes. That's an older study now, probably about 8 to 10 years now. But I remember their conclusions were the same. The metals are indeed collars work well across the board, but in certain assets like metals, they really work well. Matt, what are your thoughts on taking that collar strategy we all know and love and applying it to other asset classes?
Yeah, I love it, Mark. As you say, that slope figure, for example, is used to be 8% in the SPY. And what that means is every 10 deltas, the volatility at the lower strike, or as some would call the put strike, is 8% higher than the 10 deltas above that. So for gold, however, there's a negative skew. So that means that as you say, the call implied volatility, or the higher strike implied volatility, is higher than the lower strike, or typically the put out of the money put implied volatility. So that caller really, you could do it for a credit, meaning if you sell a call and buy a put, usually with stocks you're paying if it's about equally out of the money, but here you could do it for a credit. And Bitcoin is similar. When I did my first trade in Bitcoin on the show, the skew was larger. Now the skew has come down a little bit, but whereas gold has what is it today? Let me just get a -2 slope. BITO has a -0.2. So not quite as skewed is Bitcoin as gold, Mark.
That's a good point about crypto. I neglected to mention them. That is another asset class that you're right, typically exhibits aggressive call skew to the upside. So if you're looking at crypto, collars could be another attractive strategy for that complex and those asset classes as well. All right, that music means we've somehow come to the end. Man, time flies when you're talking weekend risk and skew and everything else, Matt, huh?
Earnings, auto, the time flies, Mark.
What a jam-packed hour worth of options goodness, listeners. In the meantime, Matt, if folks want more options goodness in their lives outside of their appearances on this program, where should they go? What should they do?
Yeah, so go to orats.com. Our latest and greatest is we want to be the best broker-neutral platform out there. We're about to add interactive brokers, which is huge. So an interactive broker is typically their front ends are hard to use, complicated if you're not used to them. But ORATS is easy, tied in. I mentioned earlier that stock scanners can feed the option scanners, and the option scanners can be clicked on, and you could set up a trade, see what the price is, see what the theoretical values are before you send them to the market. So it is such a great way to trade. I love trading on it. And come on over and give it a try at orats.com, Mark.
I have been messing around with Otto and some of your trade builders during the show here, Matt. So I blame you for distracting me during the show here with all these cool tools. Check them out for yourselves. Orats.com, ORATS.com. The place to go to kick the tires and light the fires. And while you're online, listeners, maybe you want to check out maybe that collar study I was just talking about, or all the other research our friends over there at the OIC have for you. Only one place to go, optionseducation.org. Lots of great data, research, educational information to help get you up to speed on these crazy options things. That's going to do it for us on the Advisors Option here. Not done on the network today, though. I'll be back for all you pro folks in a little bit with our good buddy, Mr. Once and Future Dr. Vix, to break down all of this fun. Maybe I'll mention Matt's short VXX trade, see what he thinks of that over the weekend as an alternate way to play the weekends out there. But your questions are coming in fast and furious. Make sure you get them in now. That session will start in a little less than an hour. Of course, if you want to check out the pro for yourselves, theoptionsinsider.com/pro is the place to go. Back again tomorrow with a double header of Options Bootcamp. I know you folks all love it. Matt's been on that show a few times. Have to get him back on that show. It's always a fun one. Thursday, our doubleheader. This week in Futures Options and the Option Block. Friday, yet another doubleheader. No rest for the wicked. Volatility Views at noon Central, followed exclusively for all of our pro friends. We come back for a little bit of unusual activity with Options Oddities. Then we'll be back again next week, and indeed next month, with another episode of the Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.